Welcome to our deep dive into the fascinating world of market analysis using the square of 9. Today we'll unravel the mystery behind how price and time interact in the financial markets, a concept that has intrigued traders for decades. By understanding how price squares with time, you can gain a powerful edge in identifying potential turning points and trend changes. Whether you're a seasoned trader or just starting out, mastering these techniques can help you see the markets in a new light. Let's begin by exploring what it really means to square price and time, and why this concept is so important for market forecasting. Squaring price and time means aligning price levels or ranges with time units, often using degrees on the square of 9 chart. For example, if a price range and a time period both correspond to the same degree angle, they are said to be squared. This relationship can also involve oppositions, such as 90 or 180 degrees apart. The idea is that when price and time align in this way, significant market reactions often occur. Understanding this relationship is key to predicting market behavior and planning your trades more effectively. The concept of squaring price and time is more than just a mathematical curiosity. It's a practical tool that traders use to anticipate market movements. By identifying when price and time are squared, you can spot potential turning points, trend reversals, or price targets. This approach is especially valuable for those who want to add a geometric and mathematical edge to their market analysis. Let's look at how this method can be applied in real trading scenarios. There are 5 primary ways that price can square with time in market analysis. Each method offers a unique perspective and can be used to identify different types of market behavior. These methods include squaring the current price with time elapsed, squaring time in a prior trend with the current price range, and more. By mastering these 5 approaches, you'll be able to analyze the markets from multiple angles and increase your chances of making successful trades. First way to square price and time is by comparing the current price to the time elapsed since a previous change in trend. This method helps traders identify when a market might be ready for reversal or continuation. By calculating the degrees for both price and time and seeing if they align or oppose each other, you can anticipate significant market moves. This approach is especially useful for spotting key moments in trending markets. Second method involves squaring the time spent in a prior trend with the price range of the current trend. This technique can reveal when a new trend might be reaching a critical point. By analyzing the relationship between past time periods and current price movements, traders can gain insights into potential exhaustion or acceleration points in the market. This method is particularly effective for swing traders looking to time their entries and exits. The third approach, traders square the price range from a prior trend with the time elapsed in the current trend. This method flips the previous one, focusing on how past price movements relate to current time periods. It's a powerful way to detect when a trend might be running out of steam or preparing for a significant move. By monitoring these relationships, you can better anticipate market reactions and adjust your strategies accordingly. Fourth method focuses on squaring the price at the end of a prior trend with the time elapsed in the current trend. This approach is useful for identifying when a market might react to previous significant price levels, especially after a major move. By aligning these 2 factors, traders can spot potential support or resistance zones and prepare for possible reversals or continuations. Fifth and final method involves squaring the price range and time within the current trend itself. This technique is particularly helpful for traders who want to monitor the ongoing strength or weakness of a trend. By keeping an eye on how price and time interact as the trend develops, you can make more informed decisions about when to enter or exit trades. When we talk about price in the context of squaring, it's important to clarify what price means. Typically, traders use the closing price, but it's also common to check the high or low depending on the direction of the previous trend change. The price range can be measured in several ways, such as close to close, high to low, or low to high. All these methods are valid, and the choice often depends on your trading style and the specific market you're analyzing. Visualizing price movements can help you better understand how price and time interact. Imagine price as a unit of energy, constantly changing direction and level, but only measured at specific moments in time. This perspective can help you see why different price range measurements are all valid, and why it's important to experiment with various approaches to find what works best for your trading strategy. One interesting debate among traders is whether to use 2-digit or 3-digit price conversions, especially when working with instruments like the DJX. Some prefer to convert natural 2-digit prices to 3 digits for consistency, while others stick with the original format. There's no universal rule, so it's up to you to experiment and see which approach yields the most reliable results for your analysis. Time in the context of squaring usually refers to the number of bars or trading days since a previous event. Some traders get creative by converting days into hours or minutes, or even relating time to degrees of Earth rotation. However, the most straightforward and widely used method is simply counting the number of trading days or bars. This keeps the analysis practical and easy to apply. Finding a trend can be tricky, as it depends on your time frame and risk tolerance. Generally, a long-term trend ends when price breaks beyond a key channel boundary, while a short-term trend ends when the same happens on an hourly chart. In this context, the terms trend and swing are often used interchangeably. Understanding when a trend ends is crucial for applying squaring methods effectively. It's important to remember that while many trends end when price and time are squared, not every squaring event will result in a trend reversal. Sometimes you'll see a hesitation, a temporary pullback, or even an acceleration in the same direction. The key is to use squaring as one tool among many in your trading arsenal, and to always consider the broader market context. Gann, the legendary trader, believed that every market high and low was mathematically related to at least one other high or low, and often several. He used long-term charts, sometimes spanning a century, to uncover these relationships. While most modern traders don't have the patience for such exhaustive research, the principle remains valuable. Markets move in mathematically predictable ways, and squaring price and time is one way to tap into this predictability. Square of 9 uses degrees and angles to relate price and time. Key angles like 90, 180, 270, and 360 degrees are considered especially important in market analysis. For example, if a price corresponds to 239 degrees, its 90-degree opposition would be at 149 or 329 degrees. These angular relationships help traders identify critical points where the market might react. Let's walk through a practical example. Suppose you have a base price of 935.05 and want to see if it squares with 37 time units. Using the square of 9 formula, 935.05 converts to 239 degrees. The 90-degree oppositions are 149 and 329 degrees. If 37 time units convert to 150 degrees, you can see that the base price and time are nearly squared at a 90-degree offset. This kind of calculation can help you pinpoint potential market turning points. Angles like 90, 180, 270, and 360 degrees are considered the most important when analyzing daily charts and longer time frames. These angles often correspond to significant support or resistance levels in the market. Some traders also look at 45 or 60-degree offsets for additional insights. Experimenting with different angles can help you discover which ones are most relevant for the markets you trade. There are no hard and fast rules when it comes to squaring price and time. Traders are encouraged to be creative, experimenting with different price ranges, time frames, and angles. Day traders in particular often develop unique variations that suit their specific markets and trading styles. The only real limits are your imagination and the laws of mathematics. To make calculations easier, many traders use online square of 9 calculators. These tools allow you to quickly convert prices and time units into degrees, helping you identify when squaring events might occur. By automating the math, you can focus more on interpreting the results and making informed trading decisions. Every trader is different, and the best way to use squaring methods is to customize them to fit your own style and preferences. Try experimenting with different price ranges, time frames, and angles to see what works best for you. Over time, you'll develop a personalized approach that gives you the confidence to act decisively in the markets. Here are a few tips to help you get the most out of squaring price and time. Always consider the most important angles like 90 and 180 degrees. Double-check your calculations using different price and time measurements. Don't be afraid to experiment with variations, and remember that not every squaring event will lead to a major market move. Use squaring as part of a broader trading strategy for best results. While squaring price and time is a powerful tool, it's important to avoid common pitfalls. Don't rely solely on squaring methods for your trading decisions. Always consider other technical and fundamental factors. Be wary of overfitting your analysis to past data, and remember that markets can be unpredictable. Stay flexible and open-minded in your approach. Squaring price and time works best when combined with other technical analysis tools, such as moving averages, trend lines, and volume indicators. By integrating multiple methods, you can build a more robust trading strategy and increase your chances of success. Use squaring as a way to confirm signals from other indicators, or as a standalone method when the setup is particularly strong. Principles of squaring price and time can be applied to any market, from stocks and commodities to forex and cryptocurrencies. However, each market has its own unique characteristics, so it's important to adapt your approach accordingly. Pay attention to the specific price ranges, time frames, and volatility of the market you're trading, and adjust your squaring methods as needed. Let's take a closer look at how squaring methods can be applied to the DJX. By experimenting with both 2-digit and 3-digit price conversions, traders can see which approach yields more consistent results. Analyzing the DJX with different squaring methods can help you identify key turning points and improve your overall trading performance. Swing traders can benefit greatly from squaring price and time, especially when looking for short to medium-term market moves. By aligning price ranges with time periods, swing traders can better time their entries and exits and avoid getting caught in false signals. This approach can add a new dimension to your swing trading toolkit. Day traders often develop creative variations of squaring methods to suit their fast-paced trading environments. By experimenting with shorter time frames and smaller price ranges, day traders can use squaring to identify intraday turning points and capitalize on quick market moves. The flexibility of squaring methods makes them ideal for adapting to different trading styles. For long-term investors, squaring price and time can help identify major market cycles and turning points. By analyzing weekly or monthly charts and focusing on larger price ranges and time periods, you can gain insights into the broader market direction. This approach is especially useful for those who prefer to hold positions for weeks or months at a time. Many traders use custom software to display price data and measure swings using different price points, such as bar highs, lows, or closes. These tools can help you construct roadmap charts and channels based on your preferred squaring methods. By leveraging technology, you can streamline your analysis and focus on making better trading decisions. Visualization is a powerful tool for understanding how price and time interact. By plotting price and time on charts and using geometric shapes or angles, you can gain a clearer picture of market dynamics. Visualization can also help you spot patterns and relationships that might not be obvious from raw data alone. Don't be afraid to experiment with different angles when applying squaring methods. While 90 and 180 degrees are the most commonly used, some traders find value in exploring 45, 60, or other angles. The key is to test different approaches and see which ones consistently produce reliable signals in your chosen markets. One of the most important lessons in squaring price and time is that there are no hard rules. The methods are flexible and can be adapted to suit your trading style, market, and preferences. The only real constraints are your creativity and the underlying mathematics. Embrace the freedom to experiment and develop your own unique approach. W.D. Gann's work remains a cornerstone of market analysis. By studying his methods and adapting them to modern markets, you can gain valuable insights into how price and time interact. While you may not have the patience for 100-year charts, the principles behind Gann's techniques are still relevant today. Use them as a foundation for your own trading journey. If you want to dive deeper into the square of 9 and related concepts, there are many resources available. Articles, calculators, and software tools can help you master the techniques and apply them to your trading. Take advantage of these resources to expand your knowledge and refine your skills. If you're new to squaring price and time, start by focusing on the basics. Learn how to convert prices and time units into degrees and practice identifying key angles on your charts. As you gain experience, experiment with different methods and see how they perform in real market conditions. Remember, practice and patience are key to mastering these techniques. Once you're comfortable with the fundamentals, explore more advanced squaring techniques. Try combining different methods, experimenting with unusual angles, or integrating squaring with other technical indicators. The more you explore, the more insights you'll gain into market behavior and price dynamics. Markets are constantly evolving, and successful traders adapt their methods to keep up. Regularly review your squaring techniques and make adjustments as needed. Stay open to new ideas and be willing to tweak your approach based on changing market conditions. Flexibility is key to long-term success. To recap, squaring price and time is a powerful tool for market analysis. By understanding the 5 main methods, experimenting with different angles, and integrating squaring with other techniques, you can enhance your trading performance. Remember, there are no hard rules. Use your creativity and mathematical skills to develop a personalized approach that works for you. Squaring price and time offers a unique perspective on market behavior, blending mathematics, geometry, and trading psychology. Whether you're a day trader, swing trader, or long-term investor, these methods can help you spot opportunities and manage risk more effectively. Keep learning, stay curious, and continue refining your approach as you gain experience. Ready to take your trading to the next level? Start by applying the squaring methods we've discussed today. Use online calculators, experiment with different price and time measurements, and track your results. Over time, you'll develop a deeper understanding of how price and time interact, and you'll be better equipped to navigate the markets with confidence. If you're interested in learning more, check out related articles and resources on the square of 9, Gann theory, and market analysis. The more you study, the more tools you'll have at your disposal. Continuous learning is the key to staying ahead in the ever-changing world of trading. Trading is a journey best taken with others. Join online communities, forums, or study groups to share ideas, ask questions, and learn from fellow traders. By collaborating and exchanging insights, you'll accelerate your learning and stay motivated on your trading path. Thank you for joining us on this exploration of the 5 ways that price squares with time. We hope you've gained valuable insights and practical tips to enhance your trading strategy. Remember, the journey to mastering market analysis is ongoing. Keep experimenting, stay curious, and never stop learning. Wishing you success in all your trading endeavors.